we promised a deep dive into the methodology behind the Roth conversion report, and this is it. This is the extended director's cut tour of the Roth conversion report. It's not going to be so much a tutorial on how to use the screen. I'm more going to be walking through what's the math behind what's going on to create those projections that happen on the screen. So let's get into it. I'm going to start a new Roth conversion projection. And I should say this actually before I start. The goal of this report is not to replace a Money Guide Pro or a Right Capital or an eMoney or any of these products that are really like purpose-built products for creating projections for clients, like projecting out, if you have this behavior, here's what your retirement's going to look like or whatever. We're more trying to create a simplified version of that, yes, but primarily for the purposes of comparing two projections. So all else equal, we're trying to show if we set these parameters, if you do a Roth conversion or not, what's going to be the long-term benefit of doing that Roth. We're not trying to be able to replace these other products that can tell a client, if you do X, Y, Z with your spending or your saving, this is what's going to happen to you if you retire at age 70 or whatever. Like they're dedicated products for doing that. We're just really trying to take people quickly from scenario analysis to being able to tell a story quickly about, is this Roth conversion beneficial or not, all right? So there may be elements of this methodology that don't go into the level of detail that you would prefer, and if that's the case, there are these other products. Now that said, this is something we can iterate and improve upon over time. So we'll just have to try to always weigh, how complex do we want this thing to be, and how complete do we want it to be in terms of being able to capture each and every little bitty edge case and specific thing for a client. So for example, inherited IRAs, those have their own RMD rules, not really something we captured within this system, right? Because to us, we're trying to capture Roth versus not. Anyway, all right, so let's get into it. So first thing to know is these values are sourced from the scenario analysis that spawned this Roth conversion analysis. All right, so in this case, we did a $95,000 Roth conversion. In year zero, before we even start, what's happening there is $95,000 is taken out of, in this case, client one's tax-deferred assets bucket and dropped immediately into the Roth assets bucket. So on day zero, okay? And then the cost, which is calculated within scenario analysis, that's the incremental cost above the tax bill they would have had they not done a Roth conversion. So in this case, $8,115. On day zero, that is subtracted from the taxable assets bucket. So the assumption within our projection is that the client has sufficient assets to pay for a Roth conversion out of taxable. And then also it's important to note that when that $8,000 comes out of the taxable account, we don't calculate any sort of capital gains taxes or anything like that. So we're assuming that it's paid for out of cash or something like that. And I point that out because that's actually different from the behavior we're going to see throughout the projections after day zero, years 1 through X. We actually do try to capture the capital gains impact of money coming out of the taxable account, the taxable bucket. So that's just something to keep in mind. These really these adjust our starting values of our buckets of assets, all right? Speaking of which, let's get to those buckets of assets. So taxable assets, this is up to you, but really you're looking to capture there any taxable assets that could actually be used by the client to cover spending. So you're not going to put a depreciable asset like the car in there. You may not even put the house. That's really your choice as to how you normally project these things out. The reason that cost basis field is there, so that's the cost basis with respect to that entire taxable assets bucket. We're going to talk about how that gets used, but it is used when money starts coming out of taxable. The cost basis is important. Tax deferred assets. Right now, at least, it's one huge bucket. And so I know there are cases where, say, a client, they'll have IRA money and maybe some employer type money, and if they're still employed past RMD age, this just assumes that everything is coming out RMD at RMD age, right? So it treats it as if it's all IRA money. And then Roth is just a combined account across the two. I think I'll get to this later, but if somebody, once one of the two clients dies, we assume that the entirety of their individual assets get transferred to the other client. So it's not like a piece of the IRA goes to children or someone else like that. All right, so moving on. And the Roth is one pooled, even though each client may have their own account, we treat the Roths as just one big pooled asset because there's no RMDs on that, so we can treat it that way. All right, so moving on. Rate of return, it defaults to 8%. This next one here, portion of returns that are capital gains. I'm going to set that to 25% just so the math is easier for me. But basically what we're saying there is we're going to walk through every year, we're going to take the amounts in the accounts and we're going to apply, in this case, an 8% gain to them. But the taxable account, we have to try to figure out what the tax implications are of this income that we're adding, right? This investment income we're adding. And so in this case, total of 8%, but 6% is going to be interest and dividends, taxes, ordinary income immediately. But then a fourth of that 8%, so 2%, is going to be treated as capital gains and actually not realized in that case. So we're going to say that the capital gains just add to the total account value and don't actually get realized until we have to sell or start taking money out of the taxable account. Moving on, life expectancy. We're going to default that to 100. I'll set it to 102 because I want to make sure that we get to the point where the assets run out. Social Security will default to be the year that the client turns 70. You can change that, obviously. One good suggestion we've had is to pull the Social Security amounts off of scenario analysis so you don't have to enter them twice. So by the time you see this, maybe we will have done that. I think that's a good idea, easy thing for us to pull over. All right, moving on. Let's have this person live to 102 also. Let's give them $25,000 in Social Security. Spending. Let's say they spend $130,000 today. Now, whenever we're entering amounts, so let me go back actually, Social Security. This $25,000 I just entered for Social Security, even though it's happening in 2026, I'm going to enter it in today's dollars. The system will automatically inflate it, right? So I don't have to come up with whatever it's going to be in 2026. I put it in today's dollars, and then we have an inflation assumption later on. All right, moving on. Oh, there it is, inflation assumption. So it's important to note that this inflation assumption applies to the stuff that's within the Roth conversion report only. It does not apply to how we inflate tax brackets and standard deductions, things like that on the tax side. That right now, that's a setting that's hard-coded. Possibly by the time you see this video, we're going to open that up, so that'll be a setting in and of itself. So just so you know, like it says right here on the thing, but spending, Social Security, and wages, it does not get applied to brackets and standard deductions. Again, that's elsewhere. Finally, this has confused some people. It's not really a methodology thing, but when we're presenting total account values to clients, most software traditionally, and then most of our reporting, will treat an IRA the same as a taxable, the same as a Roth account, right? Let's say it's worth $100,000. Well, the reality, though, is that IRA includes some liability. It's difficult to calculate what that liability is, but it has a tax liability built in. And so if we're truly going to show the client, especially when we're talking about portfolios that include Roths and don't include Roths, to make a level playing field, we need to make sure that we scale the IRAs down by some amount to make sure we're showing the client, like, okay, there's a piece of this IRA that is a liability to the government. So it's not really worth $100,000 the way a $100,000 Roth would be. There's some amount that's different. We default that to 24%. I think there's probably room for some pretty interesting academic research on what an appropriate amount would be to put in that value, but you're just going to have to think about roughly what's the average of my client's tax bill going to be, at the margin or blended. And this little toggle, we can show that later, but that little toggle, when we run the whole projection, we actually create versions of the total account value with and without this adjustment on them. So you can kind of flip back and forth between both. And then do we sunset the tax rates in 2026 or not? It will default to sunset them, which is going to be better for the Roth case because with higher taxes, greater tax drag, the Roth conversion is more valuable. All right, so I'll complete that. And so right now it's running. It's chugging through year after year, running the entire projection. I'm going to make a couple more little changes, and then we're going to talk about how we actually do the math on this stuff. Let's put in some wages. Let's say this person isn't quite retired yet. So let's say in 2022, they're making, I had numbers here I wanted to use, $50,000. So close to retirement. We'll say in 2024, they fully retire, right? And let's look at spending too. Let's say that, yeah, they spend $130,000 today, but when they retire, they're looking to do a lot of travel. And so we're going to say $170,000. Whoops, $170,000. And again, we're putting in today's numbers, values, and then it will inflate those numbers for us based on the inflation assumption we've entered. All right, so it's rerunning it now, and in a second we'll see it finish. So I want to talk about, I'm going to pop up the code on my screen, and I want to talk about now the actual order of operations, how we actually create every single year as we draw this curve out of what's happening with the base case versus the Roth. We need to make sure we understand how those values are being derived. Yeah, I kind of wanted them to run out of money. Let's make them spend a little more. 200,000? Let's try that. Anyway, I want to actually have them, the thing curve back down. So here's the order of operations. As every year that we run through, we're basically calculating the entirety of the portfolio size. All right, so the first thing we do is we're going to do some initial stuff to just figure out how old are the two people, do they have RMDs, what's their RMD age, are any of the people not alive anymore, in which case we have to make sure that we shift things from one place to another, and I'll get to that stuff when someone dies. But once we start getting into the year by year, the first thing we do is we calculate the investment returns. Now recall that we put in an 8% assumption, and a portion of that is treated as capital gains. All right, so that's the first thing we do. We take the four buckets of accounts, and we just, in this case, multiply them by 1.08 to get the new account value. All right, and it's important to note that I do that before taking any money out, before I start taking money out for RMDs. All right, then we have to figure out what their income is. Right, so we're trying to figure out how much money, because we're going to talk about spending in a second, but first we have to talk about, okay, how much income is out there to cover whatever their spending amount is going to be. So the first thing we do is we look at wages. Remember, we entered wages, and those are inflated every year, so we pull in that year's inflated wages. Then we calculate the Social Security. I'm just looking through it here. Yes, we look at the Social Security, and we inflate that as well. Now, what we do with Social Security is if someone dies, and I know it doesn't always necessarily work this way, but the assumption we use for Social Security is when someone dies, the surviving spouse is going to get the higher of the two benefits in our system. Right? I know that's not always how it works, but a lot of times that's how it works. So that's what you're going to see in here. So we've done wages, we've done Social Security. Then I guess it's sort of income. I mean, it is income from a tax perspective, but we have to deal with RMDs, right? Because we're pulling money out of these IRAs, and that also counts towards the income tax bill that we're going to be dealing with in a second, right? And I actually say that's money that's available because we're pulling it out of the IRA. That's money we're going to say that's available to cover spending. If it exceeds spending, we'll shove that money back into the taxable account, right? So we calculate RMDs. Yes, the system can handle both tables, right? The joint life table for people who are 10 years in age apart versus the normal RMD table. So we calculate the RMDs for each person, and that's how we get to the total income. So it's wages plus Social Security for both clients, and then RMD for both clients. Or if it's just one client, it's one. So that's all the income piece, all right? Now we have to figure out what is the spending that needs to be able to be covered by that income and the portfolio. So if the income is insufficient to cover spending, we'll pull from the portfolio. If income exceeds spending, we'll put money into the portfolio, right? So now we're figuring out what spending is. And so we have two components of spending. One is that spending assumption we entered, which I believe was $130,000 in this case. And then remember, we had it bump up in 2024. That's the first spending piece. And the second spending piece is we have to cover the taxes we just generated, right? We just made money on investments. We just did RMDs. We just made Social Security. We have to cover that tax cost. That's expense number 2. And so we do a tax calculation. Fortunately, we have a tax calculation engine. We calculate the taxes based on those income items that we just entered. Now, this is an important point. We calculate the tax on those income items only: wages, Social Security, RMD, and investment interest, investment income in the taxable account. You may have spawned this Roth conversion report from some scenario analysis that had Schedule C or Schedule F or all that stuff. We don't have a way to really go into that level of detail within the screen on those other sources of income. Otherwise, we would have to think about it. We would have to have like basically every single field within scenario analysis would have to be in this Roth report, and you'd have to be able to say like when did they end or start or change, like Schedule C income. How are you going to project that out for 40 years and all that stuff? It just would have been very complicated from a data entry perspective. So that's a major simplification. If you're dealing with someone who's still in the accumulation phase and they have massive amounts of different sources of income, it's going to be challenging to capture all that. And so you're going to have to ask yourself, am I capturing enough to be able to capture the Roth versus base case question? I think once you reach closer to retirement age, when those sources of income are starting to dry up anyway, it's a lot more simple of a case, a lot more of a slam dunk, I would say. So that's how we calculate total expenses. It's going to be the spending plus the taxes. That's the total expenses. And that ultimately is how we calculate how much the portfolio is going to have to contribute. It's going to be the total expenses minus the income. And if that's a negative amount, then we're actually putting income into the portfolio. But if it's a positive amount, we're pulling money out of the portfolio, right? How do we start pulling money out of the portfolio? Well, this is an important part. So there's different ways of optimizing this, and there's been good work recently about optimizing distribution drawdown strategies. We use the classic taxable first, then IRAs, then Roths. I know that like I said, there's interesting ways of optimizing around that, but at present, that's how we do it. And we do it for base case and Roth. So again, it's a like for like. So we're trying to show, is it at least directionally accurate to say that the Roth is better than the base case or not? The Roth could probably be better, and the base case could be better if we were to do some of these other optimization strategies. But we're still trying to just show, like, is Roth better than base case? That's the message we're trying to tell with this particular report. But I'm interested in that stuff. I think there's work we can do to try out some of those other distribution strategies. But anyway, we start with taxable, then deferred assets, then Roth. So when we're pulling money out of taxable, okay, what we are assuming within the system is that for every dollar that comes out of taxable, that represents, not every dollar, I mean, we can't really do it where, is this bank account money or is it something I had to sell an asset for capital gains? So we're just using that blended total cost basis versus account value, and then we're using that to determine what is the percent of any $1 I pull out of the taxable account, how much of that is going to be taxed as capital gains or not, right? We don't try to do sequencing where it's like, oh yeah, I'm pulling from cash first and then I'll raid we're using that blended, every dollar that comes out, it has some element of capital gains to it, right? That's a simplifying assumption we have. But when we do that, it's true, like when we pull, say, $10,000 out of the taxable account, well, if we need $10,000 to cover that portfolio expense line that I just talked about, of that $10,000, the $10,000 is what we need, but there's also a tax piece on top of that. It represents the capital gains that you'll have from pulling $10,000 out of the taxable account. Now also, this capital gains piece, that's money coming out of the account as well. That amount to pay for the taxes is also taxable. And so we actually calculate that, and all the way down, we kind of calculate it all the way down to the point where we have a component that is the tax cost plus the actual spending contribution of the taxable account. So that they're both going to come out of the account. And then what happens in the case where we are going to actually exhaust the entire balance of the taxable account. So let's say I need $100,000 to cover my spending, but the taxable account only has $60,000 in it. Well, then the system works backwards to say, okay, I'm taking $60,000 out because that's everything there is, and then I'm going to go raid the IRAs. But when I hit this account for $60,000, again, how much of that is going to be money that can go towards my expenses, and how much of that is actually just going to go off to taxes? And so it kind of back solves for that of the $60,000, how much is one versus the other. Now, when the money comes out, we have to readjust the cost basis assumption, right? Obviously, in the case where we bleed it dry, cost basis goes to zero. But in the case where we're pulling money out that's less than the total value of the taxable assets account, we redo the cost basis. And we basically say, well, we just sold some, and so therefore we adjust the cost basis accordingly. I will say this, I should have said earlier, when we add dividends and interest, so remember we had an 8% rate of return, of which 6% was dividends and interest. We're going to assume that that is immediately reinvested in new assets, and so therefore that reinvestment represents an adjustment of the cost basis. So if I made $6,000 in interest and dividends, I'm going to add $6,000 to my running cost basis account, so that's going to impact what happens when I take money out of the account, and then also the cost, it flows all the way through to next year, the running total of cost basis as we go through it. I should have said that earlier. So that's what happens with the taxable account. I'm going to take a break here and reset the camera because it only can record 29 minutes at a time. So I'll come back and we'll talk about what comes next, which is once we've exhausted the taxable account, distributions from the IRAs. All right, I'm back. You know it's a bad sign when you hit the time limit on your camera for such a long video. So we moved from taxable assets now to the IRA assets, right? We're going to do the same thing. We're going to figure out how much comes out to actually cover the spending requirement and how much of it's going to get bled away to tax. Before we do that, though, we have to figure out which of the two IRAs belongs to the older person. We raid that one first just because their RMDs are higher. So being able to preserve the younger person's IRA potentially allows us to have a longer amount of deferral. So we find out whoever's older, and then what we do is we do the same thing we did on the taxable side, except now it's purely ordinary income, right? So any money coming out of the IRA, we're saying is totally taxable. Now that's an important point because we don't have any sort of concept of after-tax basis in the IRA. So we're saying every dollar coming out of the IRA, we already taxed some of it when we were doing RMDs, but now there's some incremental amount that we're pulling out of the IRA. We got to figure out what the tax cost is of that. And by the way, all these times that we're figuring out the tax cost, we're kind of doing it at the margin, right? So we already took some money out. So we already calculated some taxes here. So now we're in this bracket. Now we pulled some money out of taxable. That brought us into a higher bracket potentially. We're pulling money out of the IRA. So that's all happening at the margin at the higher brackets, right? We're actually building an entire tax projection, running it through our existing tax calculation engine. All right, so we're pulling money out of the IRA. Yes, we have to figure out how much of that is taxable, and the same thing happens as on the taxable asset, which is we're going to pull some money out to meet the spending requirement. Some amount of that is taxable, but now this piece was something that came out of the IRA, and that actually generates taxes, and so on and so forth all the way up. And similarly also to what we talked about on the taxable asset side is if what we need out of the IRA exceeds the total balance of the IRA. So if we need, again, $100,000 out of the IRA, but there's only $60,000 in the IRA, we have to back solve for how much of that $60,000 IRA is going to be able to contribute to our need to cover spending, and how much of that is just going to get bled away to taxes, right? So we do that on the IRA of the older spouse if it's two clients, and then we'll just do the same thing on the second IRA. If that one's bled dry, then we move on to the next IRA and we do the same exact math there. Only when everything's been exhausted, only when all taxable assets, all tax deferred assets are fully exhausted, do we raid the Roth component. And what's easy about that one is there's no tax stuff we have to do. So we just grab whatever we need out of there to cover whatever remaining shortfall there is to cover the total expenses. And that's roughly it. So that's what happens at the end of the year. And then we do some cleanup at the end of the year to determine things like, did one person die? If so, we do that adjustment of the Social Security. We take the higher of the two Social Securities and give that to the surviving spouse. If one person dies, we take the balance of the tax deferred asset from the person who died and give that to the surviving spouse. I think I mentioned this earlier, but I should really highlight this. So we assume that the RMD happens at the very end of the year. Okay, so or rather we consider the RMD to happen after the gain on the account. All right, so let's say that we start the year with a $100,000 IRA account. I'll make the math easy on myself. If I do the RMD immediately, which is not what our system does, but if I were to do the RMD immediately, then I have a lower account balance on which we would apply that 8% investment return. So it would be a little more complicated, or not more complicated, just be a different order of operations. What we do though is we take that 100,000, we apply the 8% investment return to it. So now I'm at 108,000, and the RMD happens after that, essentially. I guess it doesn't have to be at the end of the year, but we kind of say if the returns happen over the course of the year, the RMD happens after it, right? And so the RMD does not impact the investment return that happens in the same year. Obviously, it will impact the next year because our starting point is different, and that starting point, of course, impacts the RMD for the following year. But just know that sequencing is important because that may not be how your client spends in reality. It could be that they take a monthly distribution from the IRA, and so this assumption that all of those returns are going to happen before RMDs come out is going to be like a little slightly different from reality. Now that said, again, we're comparing base case to Roth. So as long as we use the same methodology for both, which we do, you could argue that that particular assumption kind of cancels itself out across the two. Let me think if there's anything else I missed. We talked about capital gains. We talked about cost basis. We talked about what happens when someone dies. I think that's roughly it. I'll show you one more thing, which is if you want to actually see what happens, this math here, I can pop open this Excel file. Now this computer doesn't have Excel on it, so you're going to have to excuse me as I pull up the Apple version of Excel. Okay, here it is. This is that Excel that gets spit out if you want to see it. But basically it shows year by year all these things I just talked about. So it's going to show you, okay, in this case neither one of the clients died, but if they died, it would have flipped from married joint to filing single on the tax side. Here's the running tally of their ages. It has the beginning balance of all the various accounts. And so actually you can see like this tab here is the base case projection where we started with $2 million. Look at the Roth projection. Remember that we immediately take out the tax cost from the taxable account. So our starting point for the taxable account is slightly lower. Just working across here. What is all this stuff? These are the adjusted amounts. This is the total assets adjusted for. Remember we have two flavors where we can show the total assets with and without that adjustment for taxes to reduce what a tax deferred asset looks like. IR Client 1 and IR Client 2 and IR Roth, those are the investment returns. So you can see like we multiplied the actual account value by 8% in this case. Wages, I was supposed to set wages to 0. That's why everything was looking good. Look at these wages getting higher and higher over time. And then the RMDs start. Oh, sorry, this is Social Security that starts. And then RMDs are going to start. And so you can see this is how we, and then as you scroll over here, you can see like this is the amount, this taxable assets impact, that's the amount of money that's coming out of the taxable asset bucket. And only once that's exhausted do we start rating, this is the taxable asset shortfall. Only when that's done do we start rating the first tax-deferred asset. And only when that one's done do we start rating the second person's, and only when that's done do we start rating the Roth assets. And then eventually, though, it all runs out, and there's a shortfall across all the assets. So if you really want to dig into everything I just said, pull up this spreadsheet and kind of play with it, and you can see the order of operations and things and the math that's happening behind all these. And you can see at the very end the total tax bill that's happening. So you may find that useful if you really want to dig into everything we just went through. That's available just at the bottom of that little slide out panel. You can click on that Excel button and it'll give you an Excel version of everything we just talked about. All right, good luck to y'all. If this was helpful, I'm glad. If this was way too much detail, that's okay too. We've got other resources for showing you how to actually use this screen, but this is for the people who really wanted to dig into the methodology behind it. And so there you go. Let us know what we're missing. We'll probably at the end of the year we'll do a closer look at this entire Roth report, see what kind of changes we can make. I already know there's some things like pension income, which a lot of times is not, or sometimes is not adjusted for inflation, and so we don't really have a good way to capture that. So there's other little things that we'll have to figure out. Is it worth capturing this? Is it material to the base case versus Roth equation? And what are the other things that people ask for where we can just say, look, I understand that would make this the perfect academically sound projection engine, but there are other products that do that better. That's all that they do. And so we'll just have to kind of weigh that as we kind of go through things and think about enhancements to the product. All right, thank you so much. Best of luck using the Roth conversion tool.